All right. Hello, everyone. Welcome to the 13th class. Okay. We're chuckling along. We have done a lot of information, cover a lot of information, cover a lot of material. So now we're going to step into the second day of, talking about the MLO activities. We just wrap it up the loan programs, activities. Okay. Stop me. I know, sometimes that I have quite a few slides that I want to cover, for 1 hour. But more than happy. Just stop me in between if you have any question, anything that you confused, anything that I haven't able to explain clearly. Just stop me. Okay. All right. All right. 13 class. Okay. Believe it or not, right? This diagram is actually illustrates, majority of the real estate transaction, and we as MLO cover half of it, but we need to understand the whole big picture so that we're gonna able to help the clients. Sometime as an MLO, usually that if it's not your job to explain to the borrower or the buyer regarding to real estate, but having knowledge about real estate does help a lot. And that first make the borrower understand the step, the process, and all information regarding to real estate, as well as lending, mortgages and stuff, right? But sometimes have that kind of knowledge, you're actually able to keep the client, because during the process of buying home, right, both sellers and buyer, especially the buyers, right, they have a lot of stress. They have a lot of questions. They really worry, especially the one that first time home buyer, right? So you need to step in, right, to calm them down. Step in to give them information that give them confidence. Okay, at least help them to buy a home, and also keep your job and get paid, right? So you need to know all the aspects, but the more you know, the better you're gonna help the client, and the more you know, right, the easier that you can keep your income flowing in. Okay, so that's why you need to know kind of both sides. Okay, so yeah, we saw this slide before, but today I want to bring it back a little bit. That I want to go through these steps on the mortgage process. So today, we're gonna talk about the application of a mortgage loan. Application for mortgage loans are a critical step in the process of securing a financing to purchase a home or refinance an existing mortgage. One thing that it doesn't mention here is that as MLO, you can also help to open home equity line of credit. So that is a third product, right? Not only for purchase, not only for refinance, but you can also open a line of credit, to help the client to utilize that equity. Line of credit and equity, right? This is pretty much the same, because a line of credit can only be opened if there's some equity available in the property. Okay, so remember that. So all these kind of terms, last class, I give you all the terms, or majority of the term for the loan. Okay, a mortgage, related terms. So try to memorize those and know what those are. But like I say, these kind of terms you need to understand, and you need to know how to apply it. So mortgage loan applications are typically submitted to lenders or financial institution, and they serve as a formal request for a loan. And here are a couple of key items, involving the mortgage loan. So as there are like a few steps, right? As an originator, right, you first gather some information. Some people even give out the loan approval, or not a loan approval, the pre-approval letter, even before they completely process the loan. But they may know all the good information that able to give out the loan approval. But keep this in mind: some MLO they give out the letter, approval letter without running the credit check. Okay, that is a no-no. Okay, but I have seen that a lot of people are doing that because like without running the credit check, you don't have a full history of the borrower. So make sure that you have to do that first before you issue the pre-approval letter. Okay. So,
yeah, some loan officer, they just need the driver license to give out the pre-approval.
I know, I totally know. The thing is that, think about it, right? Without understand what is on the credit history, how would you be able to say that this person is pre-approved? What happened if there's some debts? What happened if there's some delinquency? What happened if there's some bankruptcy, right? Some liabilities? You don't know until you see the credit report. So not running a credit report and giving out a pre-approval letter is actually add the risk onto the file. Okay, so meaning that the file may crash, the file may get disqualified, maybe got rejected by the lender. When you after you run that and find out, right? But majority of the loan processor kind of rely on the truthfulness, no mistake information given by the borrower. If that's the case, yeah, maybe 80% is correct, and eventually it's going to get the approval letter, just fine. However, it's not that it's always going to be the case. So got to be careful. You don't want the borrower get into the transaction and it's happened that hey, you cannot qualify, right? Whose fault is that? And who got the blame? You are. Okay, so be careful, right? So the application mortgage including pre-qualification or pre-approval. Pre-qualification is like I don't just say is that give me your driver license, give me some numbers, right? Doesn't need to be entirely correct or accurate, not say correct, but not complete. Then you can use that to run a pre-qualification, and you can get the pre-qualification letter. That's just fine. Okay, but in order for the MLO to give a pre-approval letter, then almost everything needs to be looked at, right? Bank statement, W-2, pay stuff, credit payment, mortgage payment, home insurance of the existing home, property tax of the existing home, any income from a rental property, all that combined, so that you're able to give out a pre-approval letter, right? And also including the down payment too, right? You need to see that hey, you have money to make a down payment. So how much is your down? Because how much you down depending on you get the approval or loan or not, or the rate of the loan or not, right? So all that need to take into account before a pre-approval letter can be sent out. So first step, either pre-qualification or pre-approval. Second step is choose a lender. Third step is complete the loan application. Fourth step is documentation. Fifth is credit check. You get the full document in, and now you get the social security number and you do the credit check. Sixth is down payment, right? Like I just mentioned. Loan selection, you want to do 10 years, 30 years, you want a conventional, unconventional, ARM, whatever you want to do, okay? Pick one. Application fees, right? Define all the fees and costs. Appraisal, a property, and property inspection. Does this home need an appraisal or can it be waived? Okay, need an appraisal meaning that the bank got to send somebody out to appraise the home, right? To see how much is this home worth, right? Property inspection is that the buyer, the borrower, gonna hire an inspector, come out and check on the home, see if there's any issue with the home. If there's a big issue, lender may not, lender and also appraiser, if they know it, then they're not gonna allow you to borrow or the borrower to borrow a loan to buy the property. And then approval or denial. Okay, if you got a CTC, clear to close, you get approved loan. If you don't, you get a denial, right? Adverse action. Adverse action is meaning that you are not qualified for the loan, so the bank deny your loan and give you a denial letter. Closing. If everything is good, CTC and all that, loan get approved, then come to the closing time. So I'm gonna go deep into this a little bit more. So like I say, pre-qualification, pre-approval, process before you formally apply for mortgage loan. You can do a pre-qualify, and then you can, if you get pre-qualify, and then you can move forward, do a pre-approve, right, by a lender. Pre-qualification provide an estimate only. Okay, how much you may be eligible to borrow, what kind of down payment, how big of the loan is, right? And pre-approval involved in a more thorough financial review, all the documents that you submitted, right, or partially submitted, and the loan officer can review those, and loan processor will request any missing document. Okay, choose a lender, research and select the mortgage lender or financial institution offer the type of the mortgage loan that suit your needs, right? Some people actually, because after 2008, now the borrower have the power of go out and pick the lender that they want. Okay, the lender that probably give the best loan possible to that that borrower, or the lender may offer lower interest rate, right? So that's why buyer have the option to go out and pick a lender. However, right, the borrower need to be really careful when shop around and pick and choose lender, because sometime before the lender can give a pre-approved or approved loan, it's gonna take 7 to 14 days minimum. Okay, so if you choose a different lender, let's say if you already 10 days in, you pick one lender, and when the loan estimate come out, right, and when you heard somebody else may get a better rate, right, then you ditch the first lender, you go with the second lender, right? Guess what? The time gonna start all over again. Then you're gonna lose another 7 to 10 days. But what happened if the escrow that you promised to the seller that gonna close in 21 days or close in 30 days? Then you probably not gonna be able, or the borrower probably not gonna be able to meet that timeline. So be careful, right? The borrower, when they go and choose a lender, as an MLO, you need to point it out, right? If you want me to help you, I'm more than happy. I do my best to help you. But if you decided you're gonna go with somebody else, you gotta be careful, because if you do, you're gonna easily lost your contract. You don't meet the timeline and commitment, and you maybe get into trouble with that. Okay, complete the loan application. You only need to complete the loan application, okay, or the borrower only need to complete the loan application after an offer get accepted by the seller. Okay, because when you get accepted by the seller, then you get the address of the property, you get the contract that the seller agreed to sell the property to you, and then you get that and you send into the MLO, you upload on the website of the lender or the broker, and then all that take into a account, and then you complete the application. So you can fill out the application ahead of time, or you can fill out the application after you get the offer accepted. So when you get you start the application after you get accept the offer, that seems like the loan officer already give you the pre-approval without reviewing all your all your documents, right? So application need to be filled out before the offer get accepted, okay, or even before you go and you shop for a home, right? Because that information need to be reviewed to give you the pre-approval letter, right? So often in time that you see that application open after offer get accepted, okay. So also meaning that when the application created, and when the borrower go into this website, fill out all the information, including the borrower name and all the information, as well as the co-borrowers, okay, and all that need to be entered in. And the next step, submit it online, and then the system say, hey, you need to upload these documents. The borrower go and collect those documents, 2 bank statement, 2 pay stub, W-2, tax, previous 2-year tax and all that, and then upload to the website. After that got uploaded, then the MLO going to review that with the application, kind of see if they match, because sometimes you get a typo or you enter something that you estimated, but now the loan officer gonna look over and then just kind of correct it if it's needed to. Otherwise, you get a mark, approve this document, approve this section, and just move forward now. So once the offer get accepted, then the contract also sent to the loan officer. The loan officer gonna enter the property address into the application, right? The application, after it gets 6 data point, including name, financial information. Let me see what else. Name, financial information, property address, okay, liability, and a couple more, right? So once those 6 items get collected, the system gonna tell, hey, you collected all these 6 items, right? And then now it's complete the application. And then from that point on, when you say, okay, check the box, say, okay, got the complete application. Then when you save that, right, within 30 business days, not including holidays and weekend, you need to review and disclose and then send out a loan estimate. Okay, so that is required, right? If you remember in the Safe Harbor Act, that we need to disclose, you need to send out the LE within the 3 business days. You need to send out the CD 3 days before the close. Okay, so those kind of requirements in the laws that we learn in the first half of the class. Okay, so document including what? Proof of identity, driver license, passport, pay stub, W-2, tax form, bank statements. Okay, statement of financial account, saving, retirement, checking, credit card, okay, things like that. Any outstanding debts, personal loan, car loan, anything. Details about the property being financed. So let me see here. So this is, I think probably these are the 6 items. Proof of identity is 1. Proof of income is 2. Bank statement is 3. But statement of financial account is 4. Information of outstanding debt, liability is 5. And the property details is 6. Once of those 6 items get collected, the system notify the MLO, say, okay, we got all 6. Okay, let's save this and then start trigger the trade. We're talking about the trade in the law in the law section, right? The trade say within 3 days after the application submitted, you need to send out the disclosures as well as any info booklet, as well as the loan estimate. Okay, and that loan estimate also have a number of days before it's expired. So next step is to do a credit check, right? You get the application, you get the social security number, you run the credit check to get the history of the borrower, right? And any issue with the credit report. Down payment, right? The borrower say, okay, I want to make 5% down, 10% down, 20% down. You need to know that. And you need to look at the bank statement that's submitted by the borrower, see if the down payment available, right? Loan selection. Choose the type of mortgage loan that suits for the financial situation and goals. Common option including fixed rate mortgage, conventional, adjustable rate mortgages, ARMs, FHA, VA, and many different QA and QM and non-QM products. Application fees, right? Be aware that some lender may charge application fees to process the mortgage loan. These fees varies different prices. Appraisal and property inspection, right? We talked about that. Okay, approval or denial. After reviewing the application supporting document, the lender will either give a yay or nay, right? And say you can get a loan or you cannot, right? If you cannot, then a denial letter needs to be sent out. Closing. Once you get a CTC, clear to close, everything looks good, everything checked out, employment, income, debt, liability, everything, DTI, everything combined, everything's good. CTC, the lender, generate the loan doc, hire a notary person to come out and sign all those documents. The document get returned to the escrow. Escrow package it, return to the lender. Lender receive it within 48 hours. The lender fund. On the day the lender fund, right? The borrower need to wire the entire remaining cash to close, right? If you put 2% deposit, then the remaining need to be coming in. Either before the signing, right after the signing, or on the day of the on the day of the funding. But the lender will not fund until the remaining cash to close is in, right? So escrow will tell the lender, hey, we got all the cash that deposited in by the borrower. Go ahead and send me the fund. Okay, lender won't fund. There are some cases that actually roll back everything right at the last moment. And I experienced that recently too on my own purchase, right? We signed a loan doc, no reclaim, we signed a loan doc and everything. We wipe all the money in, right? On the day of, that the lender gonna fund the escrow to close this transaction, right? HOA tell the escrow officer, say, hey, we found out that this seller got the citation. This seller got a violation of illegally built. So we stopped them from building it, but here's a letter. So now they show that letter to the escrow. Escrow show that letter to me as a buyer, right? And I'm looking into that. Okay, if I want to take on, I need to sign a paperwork, say, okay, I will take full responsibility to fix up this issue, this illegal bill. Okay, either take it out or make it valid with permitted. But I didn't do that because I found out in order to do that, it may cost me 50K or 100K. I don't know the cost just yet until I get involved into, right? So imagine on the day of close, all this kind of come in, and guess what? We roll back everything, right? I got my money back. We cancel the purchase contract, and we just like back out completely, even on the day of funding. So be careful, right? All these things need to be checked out. Otherwise, it still fall through. Okay, so it's important to work closely with your chosen lender, realtor, right, and be prepared to provide accurate and complete information throughout the mortgage loan application process. Okay, next thing, origination of a mortgage loan.
Yeah, I have a question. So so when the seller accept the offer, the borrower should give the pre-approval or just the loan approval. Which one?
Okay. Okay, the process is like this. The borrower need to work with an MLO, right, to get the pre-approval letter. Okay, that pre-approval letter needs to be on hand before even go out and see a home. Okay, so you get the pre-approval letter on hand. You saw a home, you like it. You tell the realtor, hey, Mr. Realtor, can you put in an offer for me? Here is my pre-approval letter. Here's my bank statement showing my proof of funds, right? As I say, I'm gonna down 20%. Here's my bank statement showing my proof of funds. Okay, why don't you help me write an offer letter, an offer, form, right? Residential purchase agreement form, right? The realtor wrote that. Now, the 3 pieces of information. First is the bank statement show the proof of fund. Second, the pre-approval letter. And third, the RPA, residential purchase agreement, right? Those 3 combined got sent over to the seller. Okay, so at this point, it's only pre-approval letter, right? And then when that's done, application open, MLO, right, review our documents, and we submit that to the lender. The lender has an underwriter that review all the documents and make sure all the conditions are met. Conditions are met, meaning they follow the guidelines of Fannie Mae and Freddie Mac, for conventional loan and conforming loan, right? If it's not, it could be QM, but anything need to be checked out by the underwriter. So now the underwriter say, okay, everything is good. That means when the borrower will get the approved loan. Okay, at that moment, at that time, when the underwriter say you got to clear to close, you got a CTC, then that is when the borrower will get an approved loan. Okay, keep that in mind. So that's a two different thing: pre-approval letter and approved loan, right? At two different times. It could be 10 to 21 days apart. Okay, I hope that answers your question.
Yeah, but I mean, do we need the loan approval to offer the purchase, or we just need the pre-approval and they get accepted?
You only need the pre-approval to submit the offer and get accepted. But sometimes you can also get the desk underwriter. Okay, desk underwriter dig deep into the borrower financial. Okay, and they come out with almost like a pre-approved loan. Okay, almost. I say almost because there's still a lot of things need to be verified, but almost, right? Instead of give a pre-approval letter, now the loan officer run all this stuff and get the DU letter. That's underwriter letter. That letter is stronger than a pre-approval letter, right? The seller, the listing agent, when they see a DU, they like it because it's like almost like 80% approved loan. Almost. I say almost. It's not yet an approved loan until the underwriter review everything and give a thumbs up. Okay, and you only need to get the pre-approval letter. You don't need a pre-approved loan because you cannot, right? You cannot get a pre-approved loan until you get the contract, until you get the address of the property or the property information to enter into the application, right? So at the very early stage, you don't have the approved loan. You only get a pre-approved letter. Okay. So next step is origination of a mortgage loan. The origination of a mortgage loan refers to the process through which a borrower applies for and a lender processes a mortgage loan, leading to its approval and funding or denial. Right? It's crucial stage obtaining financing to purchase a home or refinancing an existing mortgage. So these are some key items for the mortgage origination. First, and also the same, pre-qualification and pre-approval. Second, the loan application, we talk about that. Third, supporting document. Fourth, credit check, property appraisal, title search and insurance. So this is something new, right? Underwriting, we just talked about that. Loan approval or denial, closing, and funding. Okay. So, similarly with the application, you need to get a pre-qualification and pre-approval. Loan application start, you need to provide a support document, including what? Pay stub, W-2, bank statement, investment statement, identification, driver license, passport, employment history, right? That's the process that in the loan origination that the underwriter or also the loan officer need to verify the employment by calling up the HR of the person that applied for a loan and say, can you verify that this person works here? Okay. And then HR say, yes, now he or she work here between here and here. Okay. So that is what they do, the employment verification. And then, even on the day of or the morning of the day of, the underwriter, the lender, gonna call HR again. Is this person still work here? Okay. Because they want to verify, because what happened if the person got laid off, got fired, right? So even on the day up before they fund, lender gonna call in, we don't have to. MLO, we don't have to, but the lender will call the company and verify the last time. Just a verbal verification. The first, verification of employment, they probably gonna need a letter from HR and say, okay, this person works here. Here's the justification, there's a verification, right? But the day of, they just call in verbally and say, is this person still work here? Okay, and if they just say yes, they do. So that's also a critical point too, right? What happened if you process a loan during the Christmas time? Everybody like take off, nobody there to verify, right? It's gonna run into a big issue, right? So maybe you need to talk before, or you may have to work with the realtor. Can we extend this to a later date because this is holiday, nobody work right now, right? So that's something that you need to look into Otherwise, on the day off, you want to fund, but nobody pick up for that verification. Guess what? The lender not going to fund it. Okay. Any detail outstanding debts. Credit check, right? The lender conduct a credit check to assess the borrower credit worthiness. This involves reviewing the borrower's credit report, credit score, and a strong credit history or background. Property appraisal, right? We talk about that. Okay, now, number 6, title search and insurance. Okay, this is a critical part in the purchase of a property. So when a buyer want to buy a home, eventually the buyer will assume the title of the home, going to be the owner of the home, right? So the escrow transaction going to have a title company involved, right? Not only that you have the buyer, not only that you have a seller, not only that you have the agent on both sides, not you only have the MLO, but you also need an escrow company and a title company. The purpose of the escrow company is to facilitate the whole transaction, coordinate everybody. Okay, the job of the title company is to go out, dig deep in the public record or non-public record, and find out if there is any issue with the title of the property that the buyer wanna purchase, right? And everything gonna fall on the shoulder of the title company if they miss something. So that's why they're gonna have 2 type of insurance, which is called a title insurance. The first type of insurance, I think like the next item will talk about more about this, but I want to discuss this a little bit ahead of time. So the first title insurance is to protect the buyer, the borrower. Okay, that's say if there is the issue that the title company couldn't find out, they may done a good job, but there's something that hidden, right? Like a will, for example, nobody know about it. A trust, for example, nobody know about it. And then at the later time, when somebody brought it out, right? And then when everything is exposed, then title company will pay back the borrower. Okay. So the second type of insurance is the lender title insurance protection. So now it's protect the lender, right? And the buyer, the borrower will have to pay for that. The title insurance that protect the buyer, the seller have to pay for that. Okay, so there are 2 types of it. So that's saying if there's anything wrong with the title, then that insurance will pay back all the money to the lender. Okay. All right. So underwriting, right? All documents collected, all the condition is satisfied at least, and then all that sent to the lender. The lender pass it on to the underwriting department to review all those documents and to make sure everything is correct. Okay. And then underwriter say everything looks good, give it a CTC, give it an approved loan. Or this person doesn't qualify because he just lost a job. Or this person does not qualify because the income doesn't meet. This person doesn't qualify because the DTI is too high, right? Or he just go out and buy a car, take a loan, buy a car. So the thing that you tell the buyer, don't open the credit card, don't buy a car, don't take on any loan, don't move the money around, right? Don't do anything that's going to jeopardize the underwriting reviewing, right? So that is something that you need to tell the borrower, that even you tell the borrower, don't file your tax yet until you complete with your purchase, because you never know, especially if you go back to 2020, right? 2019, everybody make good money. 2020, everything shut down, right? People that doing your business got no income. And guess what? You go out and you buy a home, let's say on March. And then the tax filing is due date is April 15, right? You should wait until you complete the buying of the home before you file tax. Otherwise, if you lost an income, if you whatever reason, right, you're gonna get disqualified. So that one thing that you need to keep in mind of the timeline of the year too. As an MLO, as a good MLO, you need to keep that in mind too. Okay, this person. Okay, now we in January, huh? Okay, by the end of January, you're gonna get all the document for tax, and you can go out and file a tax. But if you're buying right now, you're gonna close the home maybe in February or March. I would suggest you don't go out and file a tax. If you have to extend it, because if you do, who knows what? I don't know. Your income gonna jeopardize. Underwriter gonna look at the new tax form, right? That you provided. No, they can look at the 2023, 2022 tax form, but now you provide 2024 tax form. They have to look at it too. Okay, so that's something keep in mind as an MLO, as a smart MLO. You need to keep track of the timeline, and you need to keep track of all the things that gonna jeopardize an approved loan. Okay, good stuff. Now, right, if you get a denial, you get a denial letter, get approved, let's move on, go to the, get an output docs and for notary. And then, like I said, on the day of closing, everything got funding, money in, close, change of title, and then get record, get a key. Okay, next, title insurance, right? I just mentioned earlier. Title insurance is a type of insurance that protects property owners and lenders from financial losses related to defects or issues with the title to a property. It is typically purchased during the process of buying or refinancing real estate, such as a home, and provide protection against potential legal and financial risks associated with the property title. So like I said, the title is hidden, okay? Even though the title is stored in the county. Okay, when you change the name from Mr. A to Mr. B, you go to the county, you're gonna see that Mr. B gonna be on the title. Okay, you run a public record, you can see there's a deed transfer from Mr. A to Mr. B, right? But this may be hidden, something hidden. Before that even happened, right? Mr. A may get a divorce, Mr. A may get an inheritance, Mr. A may, borrow a private loan without disclose, right? Without a record. Then there's a lien, a hidden lien, or whatever the reason is, which is something that hidden that the title company cannot even find out. So that's why you need a title insurance to protect the borrower as well as an insurance to protect the lender too, because both of those entities, right? Actually, the one that put out the money, the borrower put out the money, the lender put out the money. So there gotta be some protection. So this also give an indication that try not to do for sale by owner. Try not to buy from the for sale by owner. If you do, make sure you follow the escrow process. Otherwise, this kind of thing gonna come back to you and bite you. You can lose $100,000 or $1,000, right? Gotta be careful on that one. Okay, so whoever say, "Oh, I'm gonna buy for sale by owner," say, "Do you know what you're gonna get yourself involved into?" So just so you know, what is for sale by owner? For sale by owner is that the owner think that he knows a lot, and he want to save some of the commission, some of the fees, so he want to sell by himself instead of need an agent to help him sell, right? Then when he sell by himself, then you as a buyer, you need to have your realtor represent you, right? Or if you listen to what the seller say, "Oh, it's easy, I can help you," then you're gonna get yourself into a big trouble, down the road. So here are a couple key aspects of the title insurance. What are the purposes? Two types of title insurance. What the premium, title search and examination, coverage, claim process, continuation of coverage, owner's policy benefits. Okay, the purpose of title insurance, including safeguard the property owners or lender interests in the event of dispute or claim arising from problem with the property title. Common title issue may include unpaid liens, right? Undisclosed easements, prior legal claims, errors in public record, and fraud in the chain of title. Okay, sometimes the fraud could happen like the previous two transfer, and now somebody find out about it. It's gonna affect, the current borrower or buyer. Okay, like I say, two types of title insurance. The owner title insurance. This policy is typically purchased by the home buyer and protect the owner's equity in the property. It remains in effect for as long as the owner or their heirs have an interest in the property. Okay, so this owner title insurance is paid by the seller. Okay, lender title insurance, which is what they call is a loan policy. Okay, lenders often require borrowers to purchase a lender's title insurance policy to protect their financial interest or their financial investment, right? When they lend the money to the borrower for the property, right? This policy amount is based on the loan amount and decrease as the loan is paid out. I think I forgot like what is the how they calculate the title insurance money. I think like the next few classes we may touch base it, but I think like for every 1,000 there is like a $10 or $100, right? So the title insurance is probably in the like between 1,500 to 2,000, okay, or a little bit higher than that, just a little bit. Okay, so what are the premium? A one-time premium is paid for title insurance, which is, they're just saying an amount 1,500 to 2,500, let's say, at the time of purchase a home or refinancing a home. The cost of a title insurance can vary depending on the property location, purchase price, and the insurer. It is typically a percentage of the property purchase price or loan. Okay, so and I think I will have that in the next class. Title search and examination. Before issuing a title insurance policy, a title company conducts a thorough title search and examination of public record to identify any existing issues, potential risks associated with the property title. This process helps uncover any liens, adjustment, encumbrances, or other defects that need to be addressed before title change, right? Coverage, the title insurance policy typically cover the policyholder, which is the owner, the new owner, or the lender, okay? Claim process. If a covered title issue arises after the property is purchased or refinanced, the policyholder can file a claim, meaning the new owner can file a claim or the lender can file a claim with the title insurance company, right? The insurer will then investigate the claim, provide legal defense if necessary, and compensate the policyholder for the loss, okay? Continuation of coverage. Unlike other form of insurance, title insurance provide a coverage for past events, right? Anything past like 15, 20 years, 30 years ago, okay? Past event rather than future risk, meaning that, something happened in the future, you don't even know, okay? The policy remains in effect as long as the owner or lender maintain an interest in the property. So meaning that if you sell the property, if you refinance the property, refinance the property, then the lender got changed, then that old lender got no interest in it no more. So that title is dropped. And then now the new lender come on, then they need to get a new policy for it, okay? The policy remain affect as okay, an interest in the property, even if the property changes hand, okay? Owner's policy benefit. An owner title insurance policy can protect the homeowner equity and equity and ownership rights in the property. It can help resolve title dispute, legal challenges, or unforeseen title issues that may arise years after the property got purchased. Okay, here are some title insurance coverages. Standard coverage. There are actually two types of coverages, a standard coverage or an extended coverage, okay? So for a standard coverage, okay, it's including standard title insurance coverage is the basic coverage that is typically including a standard title insurance policy. The coverage protects the policyholder against specific title issues that may arise during the ownership of the property. Common cover risk or title issue under standard coverage may include forgery, fraud, or impersonation, right? If somebody make fraud, okay, create like a fake document or be pretend like an owner of the property, for example, right? Anything that affecting the validity of the title, right? Incorrect legal description or errors in the public records. Undisclosed heirs who claim an interest in the property, right? Like I mentioned earlier. Defective or improperly executed legal documents affecting the title. Either it's defective or there's a mistake, right, that affect the title. Liens, encumbrances. Liens, what are liens, right? I just want to explain that a little bit here. Liens are anything that, like a mortgage, like somebody, hire a contractor, work on the home, but not pay that contractor. The contractor can put a lien on the property, right? Encumbrances, meaning any debt, any, obligation for paying any amount of money, right? Or judgment, you get sue or whatever, right? These are the things that, I get covered, by this title insurance. Invalid deeds or conveyances. Deed is a document, it's a form, okay, that say who are the beneficiary, right? Who are the title owner, right? It's right on it. Or conveyances is usually when you pay off the property and you get the conveyance, say, okay, now everything is yours. Okay, you got no beneficiary, right? The note is already complete, you pay it off. Okay, standard coverage is usually based on the property's purchase price, owner's policy, or the loan amount, lender's policy. Okay, so two different policy, cover whatever, under the owner's policy, it covers the entire amount of the purchase price. Okay, and on the policy, the entire loan amount, okay, covered by the lender's policy. So is that clear? Two different policy. One cover, let's say the home total purchase 700,000. Okay, and the loan policy is like, let's say 400,000. You borrow $400,000 to buy the home. So the two policy cover at the different amount. Okay, extended coverage. Okay, those are the standard. Anything that we know, anything that available to the public. Extended coverage are the one that you don't know. Okay, extended coverage, also known as additional or enhanced coverage, goes beyond the protection offered by the standard coverage. This coverage provides additional protection against a wider range of potential title issue and risks. Commonly covered risk or title issue under the extended coverage may include adverse possession claim. Okay, somebody just come out of nowhere and say, I have the right for this property. Maybe because I'm the this is a community asset, right? I'm a wife, right? I may be long lost somewhere in the jungle that will come out, right? So that is an adverse possession claim. Mechanic lien, I just say it, a construction, somebody doesn't pay, the contractor put a lien on it. Restrictive covenant or violation of land use regulation, meaning that, okay, this property now wider, bigger than before because the owner is extending the fence and take on the additional land without the knowledge of the local government or whoever, right? Unmarketable title due to zoning violation or environmental hazard. So let's say that this title, right, in the in the zoning that already makes some violation, right, regarding maybe some this is a residential area, but you build a multi-family here. Okay, so you violating the zoning code, right? Or maybe there's some environmental hazard happening, right? And you still transfer the title to a new buyer, right? Okay, rights of parties in possession, including the tenants, adverse claimants. Okay, so maybe rights of parties in possession. So maybe maybe like the title cannot legally transfer when there probably some tenants is occupied. Tenant here, I don't think is a tenant that rent the place, but the tenant that we talk about the reverse mortgage, right? The person live on the property is a tenant, right? until that person died. So this title say, it's a no, this is a reverse mortgage, the bank, whatever it is, okay? But that tenant is legally has the rights, to live on it, or has some kind of rights to live on it, okay? Unrecorded easement or rights of way. So I'm talking about easement, right? Easement is the part of the land that dedicated to, local government or to the utility or to the city for road maintenance, for sewer maintenance, for electrical pole maintenance, or whatever reason it is, right? But there probably some some easement violation happened or unrecorded, okay? And so this extended coverage will cover for that too, because like if the city come back and sue this owner, and then they say owner already bought this, extended coverage, then the title company will take care of it. Extended coverage may be purchased as an optional endorsement, right? You can buy a standard coverage, but if you want to make sure, you pay a little bit more. You buy the extended coverage, right? And the standard policy and the cost typically higher than the standard coverage. Okay, conducting the settlement. So we got the application open, we got the loan process going, we review the document, and eventually we want to close it. So want to close it meaning conducting a settlement, right? All the money transfer, the title transfer, everything happened. Okay, conducting the loan settlement, often referred to as the closing. A settlement is the final step in the mortgage loan process. It involves completing the necessary paperwork, transferring funds, and finalizing the purchase or refinancing of the property. Here are the key steps for the settlement. Schedule the closing, right? When it's going to be closed. Reviewing the closing disclosure, CD 3 days before the closing. Conduct a final walkthrough, right? One of the process in the real estate is that final walkthrough between 5 days before the closing date that need to be done. Gather required. Why actually number 3? Back to number 3. Why do we have to do a final walkthrough? The final walkthrough, is an ensure that the buyer going out and see that there is no additional damages that happen. The last time the buyer visit the property. Okay, there may be some argument in the family and they fight, they throw things, they crash the window, or they broke whatever they break, right? The final walkthrough got to go back in, verify everything was as is that the last time the buyer visit the property. Okay, and when that happened, you sign it. You say, okay, I verify it. Everything looked the same from the last time I've been here. Okay, if not, then the seller need to resolve that. No loan gonna fund it, right, until everything got resolved. Number 4, gather required documentation for the final closing. Attend the closing, right? Usually, like in a different state, you may attend the closing, but in California, we really don't do that. Okay, you sign the document a couple days before, the document sent back, you stay home on the day of closing, and then you get the key when the realtor pick up the key and give it to you, and you go and you open it. It's your house. Okay, sign documents, pay closing costs, record the deed, receive the keys, obtain the title insurance. Okay, so just in detail on these steps, schedule the closing. The closing date and location are typically determined during the negotiation and contract phase of an offer. It's important to ensure that the parties involved, including the buyer, seller, real estate agents, and lender, are aware of the final closing date and time. On the final closing date, right, usually the lender want to fund the money before 2 o'clock. And then once the money is funded, between 2 o'clock, noon, until even 8 p.m., that's when the title company going to go to county and record it. Sometime on the day of closing, the county system get bogged down, right? They think it's too long, too slow, but eventually they will record it on the same day. If not, if the system is like, is shut down, maybe they're going to record the next day. That's also fine too. And guess what? When the lender fund on the closing day, right? After the lender fund, and then title going to record. Once title is recorded, and then they're gonna disperse the money. That money need to be go out to everybody, okay, including go out to the previous owner lender to pay off the loan. Some go to the seller, right? Some go to the agents, some go to the fees and all that, and some go to the escrow, right? That's called disbursement, right? If that money doesn't disperse within 48 hours, for whatever reason, no title record, nothing going on, then guess what? That money going to return back to the lender. If that money is not disbursed within 48 hours, okay? That's a crucial point. Okay, review the closing disclosure, which is a CD. In accordance with the Consumer Financial Protection Bureau regulation, borrower received the CD at least 3 business days before closing date. Remember that. The LE sent out within 3 business days after application open. CD is 3 business days before closing date. You're gonna remember my words. And then when you go sleep, you're gonna remember this. You go to take a test, you're gonna remember this. Really easy. 3 days for the LE, after application open, 3 days before close of escrow or closing date. And as an MLO, right, you need to review the CD carefully to ensure the accuracy and address any question or discrepancy with your lender. Maybe the second class I mentioned about an issue that the credit that the buyer is supposed to get $500, but eventually only get $300 something. Just because the LO didn't review the CD, right? The lender make a mistake, say the borrower cannot get the entire $500 because it's already reaching the max. But guess what? 3% seller concession cannot be $500. It can be thousands of dollars. And how can the lender say that? And the LO didn't verify that, right? That's the LO issue, not reviewing the CD. Okay, so it's really important that the LO need to review the CD for purchase or even refinance. Conduct a final walkthrough. I talked about that. Gather required documentation, right? All those required documentation need to be in, and including the sale contract, proof of homeowner insurance, proof of title insurance. So backtrack a little bit. In order for the lender to fund, there gotta be a proof of a quote, a declaration of the home insurance for the new buyer, a new owner. And that quote need to send to the lender. Lender, keep a note of that. Say, okay, this company ABC will provide the insurance for this property. Okay, when this is closed, the buyer gonna have to pay for, actually some of that already pay in the escrow, right? One of the items, okay, for prorate, for early payment of some of that money. Okay, but you gotta have that home insurance coverage in there. Otherwise, because the thing is that if there's no insurance coverage, and right after take the possession of the property, the house got burned down, then who's gonna pay for it? The lender lost some money. They lend out like $700,000. The house got burned down. Now who's gonna pay to repair that if there's no insurance coverage, right? So it's really important that need to have the insurance coverage, okay, which is the home insurance coverage, including fire as well as earthquake if we live in California. If we live in any other FEMA flooding zone, you need the flood insurance coverage too, right? We talked about that. Okay, attend the closing. Like I say, in California, usually we don't attend closing, but in any other state, you have to go into the attorney office. You got to sign all the documents. All parties get involved need to be there, okay? Including the buyer, seller, real estate agent, lender, representative, okay? The closing agent or attorney oversee the entire process on the closing day, right? For many other states, but not for California. California, we sign it up. We don't even see anybody. Okay. Sign document. During the closing, various documents will be signed by the buyer and seller. These documents may include promissory note, is an agreement to pay the lender for borrower the money based on the rate, how much you pay, any PMI, blah, 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 blah. Okay. Mortgage or deed of trust is the second document. Okay. The mortgage or deed of trust meaning that this document secured the loan against the property and allowed the lender to take legal action in case of default. So the beneficiary, the one that benefit of the deed of trust is the lender. Meaning if the borrower doesn't pay, the lender has the right to foreclosure the property or to take the property and do a short sale. Okay, short sale meaning the seller sell it, or the lender sell it, whatever the money that they need, they take, whatever remaining, give back to the owner. Okay, closing disclosure, we talk about this, right? The CD is reviewed and signed by the borrower to acknowledge the loan terms and closing costs. Affidavit and declaration. These documents may include statement confirming the property condition and the borrower's intent to occupy the property, not for renting, not for investment. Okay, affidavit is an agreement saying I'm borrow the money to buy for this property so that I live in it. Okay, but sometimes somebody does the opposite. They buy the property, but they rent it out, and that's illegal. And when that happens, the lender can call a due on sale clause. Okay, due on sale clause meaning that you need to pay me back the money because you violating the agreement. You're violating the term that you sign. Okay, you sign on the affidavit, you sign on the declaration. Okay, you sign on the agreement. You violate it. I'm the lender. I'm going to force you to pay back my money. Seller document. The seller may sign document related to the property transfer, such as the deed and the settlement statement, okay, which is the final document. Pay closing costs. The buyer is typically responsible for paying the closing costs, which may, for his or her part, for the buyer's part, the seller may pay their own costs as well, right, including title insurance, attorney fee, appraisal fee, prepay, property taxes, and other charges. Okay, payment is often made by certified check or wire transfer. Record the deed. Following the closing, the deed is recorded with the appropriate county or municipal office to officially transfer the ownership from the seller to the buyer, and then receive the keys, and then obtain the title insurance proof. Okay. Okay. Escrow account. We talk about this, right? Usually we open an escrow account for, payment, property tax, PMI, right? Insurance. Okay. So like I say, purpose of the escrow account, including property tax, home insurance, PMI, private mortgage insurance. But sometimes you don't have PMI in there, right? Or HMI or MHI, mortgage home insurance, right? For VA and FHA loan or USDA loan. Monthly escrow payments, right? We talk about this several times, that those payments for property tax, mortgage payment, home insurance, and all that need to be collected and put in this. Escrow account analysis. Lenders typically conduct an annual escrow account analysis to assess whether the amount collected throughout the year is sufficient to cover the property taxes and insurance premiums and mortgage payment. If there's a shortage in the account, the borrower may be required to make a one-time payment to bring the account back to the required level. Conversely, if there's an overage, the borrower may receive a refund or credit. The benefit of the escrow account including simplified budgeting, avoiding late payments, and provides some lender security. Okay. Last but not least, the mortgage loan servicing, right? You complete with the transaction, you consume the loan, you get the house, you get the key, everything. Now it's the payment time, right? Mortgage loan servicing is the process of managing and administering mortgage loans on behalf of the lender or mortgage investor. After the loan has been originated and closed, loan servicing involves a range of activities and responsibility related to collecting monthly mortgage payment, maintaining records, managing escrow accounts, and assisting borrowers and their loan-related inquiries. Okay, so let's go in deep on these items. Payment collection. The primary function for loan servicing is to collect monthly mortgage payment from the borrower. This including tracking principal and interest. And then send out letters, right? Invoice. At the end of the year, send out a summary of how much, how much interest was paid, how much principal was collected, okay, given overall. Record keeping. Servicer maintain a detailed records of each mortgage loan, including payment history, account balances, and other financial transactions. These records are used for accounting, reporting, and customer service purposes. Escrow management. Okay, for loans with escrow account, voluntarily or required by FHA, VA, right? These escrow accounts need to be open, and there got to be some management involved. Servicer manage and disperse the fund of the property taxes, homeowner insurance premium, and in some cases, private mortgage insurance. Servicer ensure that these payments are made on time to protect the lender interest. Communication with the borrowers. Servicers act as a point of contact for borrowers addressing inquiries related to the loan term, payment schedule, account balances, and escrow matters. They also provide statement in an annual escrow analysis to the borrower. So keep this in mind, right? For the servicer and on the escrow account, there is a required an annual escrow analysis that need to be sent to the borrower. Okay, that may be on the test too. Loan modification. In some cases where borrower experience a financial hardship or difficulty making payment, servicer may work with the borrower to explore ways that they can modify the loan, such as modify the term, the rate, the payment, the year, right? And then change the loan agreement. And also come up with some kind of loss mitigation measure. So instead of foreclosure the home, the servicer can work with the borrower to modify the loan at a lower interest rate or even extend a period of time so that fit into the borrower financial condition. So if the borrower have an issue with their, his or her financial condition, they can call in to the servicer, say, hey, I just experienced a job loss. I just experienced a medical issue, right? Can I work with you to modify my loan? Okay, so the servicer has that ability to represent the lender to help with that matter. Investor reporting. Mortgage servicers are responsible for reporting loan performance and financial data to investors or entities that have purchased the mortgage-backed securities, okay, which just stands for MBS, own the loans. Okay, so mortgage-backed security is an item, right? This loan is a MBS that sell to an investor as a secondary market or whatever, whenever the original lender want to sell. Okay, so when the original lender sell, right, they may change the servicer. And you remember we have a law on that say, okay, how many days that the old servicer need to notify the borrower and how many days the new servicer need to notify the borrower of the change, the address, where to send the money in and all that. Okay, default management. Default here meaning that the borrower not paying. Okay, now it's a process of foreclosure going to take in, and there got to be some process of management that need to get going. Okay, so meaning when borrowers fall behind on their mortgage payment, servicer may initiate a foreclosure proceeding on behalf of the lender or investor. They also manage the loss mitigation efforts to explore alternatives to foreclosure, such as short sale or loan workouts, right? Short sale meaning they take, they sell the home and take back whatever enough to pay the lender, the remaining give it to the owner. Okay, number 8, regulatory compliance. Servicers must adhere to the federal and state regulation governing the mortgage loan servicing, right? This includes complying with the laws such as RESPA. We talk about RESPA and TILA, Truth in Lending Act, the Dodd-Frank, Wall Street Reform, Consumer Protection Act. These laws coming back to you right now, right? Servicer need to follow those compliant, those guidelines, well, by those laws, okay? Transfer of servicing, right? I mentioned earlier, mortgage loan may transfer from one servicer to another, okay? Annual escrow analysis, we talked about that earlier too. Thank you. Sorry, I'm overrun 11 minutes. Good stuff, huh? A lot of good stuff. So if you see, if you're looking at this, right, this list on the left here, regarding to the mortgage process, right? From, you know, even pre-approval, loan application, all the way to closing the deal and then service the loan, okay? A lot of good information. Anybody have any question for me? Anything? Good stuff? Anything? Any question?
Yeah, very practical, useful
Very
information.
practical. Yep,
Yeah.
yep. Right. So I'm kind of cover the high level MLO activities. Right. In the next week class, I'm going to dig deep into individual one, even reviewing the 1033 or 1003. Is that 1003 or 1033? The loan application, the disclosure, right? So those are going to go in deep dive into those. Okay. But it's really practical here, right? This is what you get yourself involved into. Okay, let me drop the file one more time if you haven't got it. So any other question? So last time Trung asked about commission. So I explained about commission last time. Hopefully that if you haven't seen it, I will upload the class number 11 and 12 tonight so that you can go onto the YouTube channel and look at it. Okay, if you don't have any question, I'll see you tomorrow. Have a good night. Ciao.
Thank you.
Yeah, thank you.
Mhm.